Hi, good afternoon, everybody. Hearty welcome to one and all. We've tried to make this session a little bit more diverse by, also getting speakers from other disciplines, which will be useful for us. So we have today with us Mr. Arunagiri. Arun is from the 1986 batch of REC Trichy, and he spent about 15 years at Wipro before moving into the markets. He completed his major in finance and business management portfolio and moved into investments. And he started Trustline about 17 years back. So he got an excellent track record of 17 years where his funds have given 18.5% CAGR over the 17 years, basically. So that's a phenomenal achievement. He's garnered about 1,200 crores of assets from investors like all of us and managing that at this point in time. So what differentiates Arunagiri is his style of investing. So he is very well respected and known for his value style of investing, and that has really helped him to generate this kind of returns, basically. So Trustline's mission, as he would also elaborate, is to provide superior risk-adjusted returns on a longer-term basis for his investors. And the approach that is used is the value style with rigorous investment discipline behind it and a contrarian approach to investing. The good thing to note is he's got a 95% plus client retention rate, which means that clients, once they come in, they're very happy with him and stick on for life. And he's also on several advisory committees, including the Campus Angel Networks, etc., and as a popular socialist, social animal in the Chennai circles. Welcome, Arunagiri, here. Thank you.
Good morning, everybody. Thanks, KK, for your wonderful introduction. Very generous introduction. In fact, he is more of an ambassador than me for Trustline. He knows our history so much. Thanks a lot for that, KK. It's always a privilege to be presenting in an REC Trichy alumni network. I always value that. And so in terms of that, I think I must thank the organizers first for inviting me to share my thoughts on investing. So let me give you the context first for the topic, because the topic is a little weird. So let me give you the context for the topic. Very interesting way we narrowed down to this topic. We had a lot of options. When this opportunity came up, initially I was super thrilled because there's so much to talk. So much to talk about in terms of topics in the world of investments, finance and markets. For example, the first topic which came to my mind is about India's shining macro. Now, what is it so different now in India that it has become a magnet for global capital? Even 20 years back, the story was there. India's story was always strong. You had the demographic dividend story. You have a structural growth story. And because of underpenetration, India would anyway grow at 7-8%. It was always given. But what is that this particular regime has done? In the last 10 years, it has made this country so attractive for foreign capital. That was one topic which we thought we might look at. The second topic is the current flavor of the season. Buy China, sell India. It's a current flavor of the season. We can talk about it. Third is we thought we will take up this investing process. How to make investing process bulletproof. That's one we thought. So like that, there's so many options. In fact, we were, no dearth of options. We were spoiled for choices. While doing this exercise, we also look at our own, we went back and looked at our own track record. Like KK said, in the last 17 years, we had done, value creation of 18.54%, which is, 18x in 17 years plus. If I have to pick up a single dominant factor, which contributed to this level of value creation, what that would be. Can we take that as a topic? So that was, it made sense. So if I had to pick up, it was not the research skills, it was not technical skills, it was not a market skills. What was that one skill which I would pick? Of course, all these skills are required to make your investing process successful. But if I have to pick one particular quality which made a huge difference to our overall value creation, it all boiled down to one particular quality, which was our ability to sit tight. Then we said, why not we make that particular topic? So this is what we are going to be talking about. This topic is all about doing less to get more returns. Like Mr. Buffett says, inactivity strikes as an intelligent behavior when it comes to investing, especially value investing. Right? This is what we are going to be focusing. Before that, there's one question to all of you. The first question. If someone had invested about 1 crore in small cap mutual fund in 2004 and he forgot about it, suddenly in 2020-24 he recollected, remembered that he had invested 1 crore there, and he rushed to his financial statements, looked at his NAV sheet. What do you think would be his investment worth now, current NAV? Any guess? You were shocked. It was 75 to 76 crores. 1 crore invested. And if only he had added a little bit more active by adding a little bit more money during some of the downturns like 2008, 2013, 2018 or 2020, that value would have gone 100 crores. So we are talking about 10x in 10 returns, right? It is basically 20x, 100x in 20 years. 1 crore becoming 100 crores is in 20 years. And he has not done anything, right? It sounds so simple. Here comes the second question. How many of these investors who are investing, before that I should clarify this. I have taken the average category small cap mutual fund returns for this purpose, not the top performing funds. Probably, Sundaram from KK and all must have done much higher. Franklin would have done much higher. But I have taken the average category returns, which has done about 75, 76x. Now here's the second question. How many of these investors who are invested would have captured the entire gains? How many? Let me tell you, it is near zero. Near zero. This is where the difference between investment return and the investor return comes. The funds have done well, fund managers have done well, but the investor has not captured those returns. This is, primarily it's because of the behavior gap. So now what we are going to look at is, what are the challenges in, basically, when you look at it, what are the challenges in sitting tight? The main challenge comes in sitting tight is getting out of the way. Zen teachings tell you, getting out of the way is the most hardest thing in life. Why is it so difficult to get out of the way? Why is it so difficult to sit tight? I'll also share one more data. This is very interesting data. You look at the Apple stock price in the US, between 2002 to 2012, it multiplied by 60 times, over 60 times. In the same period, 48% of the trading sessions, it fell. Just to keep this data in your background, as we discuss this topic, you will understand more where I'm hinting at. So why sitting tight is so hard? To understand this, one has to understand the nature of this beast called market. Market is a huge magnifying machine. It takes incrementally small things and magnifies. Basically, it works like this. First, it starts with the price action. Then the narrative follows to amplify the price action, right? So just to give an example, when the stock price moves up, this is a very basic example, but it happens in much bigger way. When the stock price moves up, the media will come and tell you 10 reasons why it's moving up, right? The same stock after 1 week down, it goes down. They'll tell you 10 other reasons why it's going down. All these 20 reasons are already there. It's basically what the market chooses to magnify. So ultimately, if you strip all that noise around that stock price, if you strip it down, what is left is nothing but basic cycles. Basic cycles. You have long-term cycles, you have short-term cycles, you have medium-term cycles, you have also day-to-day cycles, right? So if you start focusing on the cycles, not on the narrative, then the game gets interesting in investing. This is one part. The second part is, the third point, the mistaken and misplaced notion that money has to work all the time. Market doesn't work like that. Market is basically a non-linear journey. The returns come in a very, very lumpy manner, right? Let me share some examples for that. When a stock price returns 10x, let's say 10x in 4 years, 3 years, it's never a linear journey. 2-3 years it just moves sideways. It doesn't give you returns at all. In just few trading sessions, it moves up substantially, give you that kind of return. That doesn't mean that 2-3 years you shouldn't wait, because it's impossible to time only that particular part of the gains, right? In our own example, we have stocks like CDSL, Sterling Tools. These are from the small cap space. These stocks, when we picked up, 2-3 years it went nowhere. And suddenly in 1 month, the stock moves up by 60 to 70%. Can you time only that 1 or 2 months? Impossible. So it's like that seed working under the ground and suddenly it sprouts. But if you want to capture only the sprouting cycle, not the ground, underground, whatever it is working, it's not fair and it is not possible. So money is made in waiting. You got to have a lot of patience to get those returns which happens in those few trading sessions, right? These are the two reasons why it's difficult. Also, sitting tight is more of an emotional quality. It's not an IQ strength. Of course, REC Trichy guys are all high IQ, I know that. But then IQ doesn't play much of a role here, right? It's more of temperamental skills. Like Mr. Buffett says, it's not a game in which IQ with 180 guys beats IQ with 130 guys. It's not that. It doesn't work that way. It's more of a temperamental skills game. So if you go back and look at some of the most successful investing organizations globally, also locally, especially in the value investing space, you will find certain qualities running as a common thread, which runs across the organization as a fabric. These are not financial skills, they are not technical skills, they are not more. Of course, all of them are required. You need research skills, they are basics. But they don't give the edge for the investment company. The edge comes from these skills: rationality, objectivity, driven by neither greed nor fear, right? Focus on the process, not on the outcome. This may sound like cliche skills. Let me tell you, in investing, the business are built, are broken by the sheer presence or absence of these skills, right? So these skills are important. Now let me come to what are the solutions, right? I'll try to wrap it up quickly. There are two things I would say to, critical for sitting tight. One, you got to look at your asset allocation. Look at what you can block and forget, and what you need for the next 1 or 2 years. You separate these two portions, because liquidity should drive asset allocation, not anything else. The moment you arrive at the asset which you can block it, the money which you can block it for a long time, that should go towards assets which can give you high yield. Could be real estate, could be equity or whatever it is, right? Then allow it to work. Don't intervene, get out of the way, right? That's very critical. And leave the assets to work. And second thing which is very critical for sitting tight is focus on the cycles, focus on the price action, not on the narrative. That requires a lot of clarity, because narratives will come and go, amplify the changes. Because let me tell you one universal truth in this. Mr. Morgan Housel, some of you must have heard of him, a very favorite author of mine. He said, all past corrections look like an opportunity. No exception. No exception. All present and future corrections look like a risk. Actually, that sums it up so beautifully. So you can use every correction as an opportunity. That's what it means. So we have spoken so much about sitting tight. Let me tell you one thing. If you buy it wrong and sit tight, then nothing works. It will be very counterproductive. Take example of Cisco stock. At the top of the dot-com boom, 2001, it was at $76, right? Adjusted for stock split. It reached a peak of 140, 145. Even today as we speak, it's at 57. 24 years, you have lost your wealth, you have lost your purchasing power, you have lost your compounding, you have lost your even inflationary build-up, right? So if you get it wrong, if you buy it wrong, there's nobody who can save. Sitting tight will be counterproductive. It will not be even, it will not help you, it will erode wealth, right? So buying right is very, very critical. So the whole investing process is about buying right, sit tight. And for buying right, of course, you can tap into managers like us, PMS, mutual funds. And even in mutual funds, if you buy it at the wrong time, then it will not help. So you got to really actively manage. But the best way for investors to tap into mutual fund is to go through SIPs so that you go through all the cycles, you manage the cycles, don't worry about the cycles, don't worry about the narrative. Just keep putting your money every month. Nowadays, you get so little amount also which you can invest through SIPs. So buying right is all about two things. One is intrinsic value of the business and the other one is margin of safety. Because as Mr. Sheth Klauman, he's also another great investor, he said much of your returns come from the buying price, not from growth. It's so crucial for value investor. A lot of your returns come from buying price. If you buy it right at a discounted value, most of your returns are captured already. So that almost comes, I come to the end of my presentation. I leave you with this thought. This is a wonderful, I think, evergreen quote by Mr. Charlie Munger. Understanding both the power of compounding and the difficulty, that's underlined, difficulty of getting it is at the heart and soul of understanding a lot of things. Thanks a lot. I think it's great to see such a level of participation on a Sunday morning. Really thank you all for coming in and supporting us. And as an event sponsor, we also have a stall, our brochures and our team available here. If anyone wants to reach out to understand more about our fund, also about our fact sheet, our team will be more than happy to help you. Thanks a lot. Really appreciate this opportunity. Thanks. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.